Hey guys, welcome back to the Beginning Investor series. In this video today, I'm going to be going over how to consistently grow your portfolio when you're investing, and there's a bunch of different ways that you can do it, so make sure you stay tuned and watch the entire video to get all of the information. Let's get right to the video. So if you guys are new here to my channel and you haven't been here before, I want to welcome you and let you know that this channel is all about my tips, tricks, and insights into the stock market. So if you're looking to grow your portfolio size, then make sure you hit that subscribe button and turn on that bell notification to be alerted when new content comes out. So like I said, in this video, I'm going to be talking all about maintaining a sustainable growth of your portfolio. And you might not see the highest returns that you could see if you were investing in riskier strategies, but nonetheless, it's going to get the job done and you're going to see your portfolio grow over time. And in my mind, there are 5 really key things to growing and maintaining a consistent portfolio. So I'm going to tell you each one of those, and the first thing that I'm going to recommend is setting up your portfolio for the long run. And what I mean by this is setting up a sort of stock preference where you're knowing that you're going to buy and hold these stocks. So going into it, you're not looking at anything for the short term, so you're not really worried about day trades or fluctuations in the market in a shorter period of time. I'm talking like 10, 20 years out, basically setting yourself up in this way because it's a lot easier to look at companies today and figure out the big players and see their growth over the next couple of years and kind of maintain and understand where they're headed. So that's super important. That's something that I value completely. What I've done is try to align my entire portfolio to be a buy and hold portfolio. So for one thing, I'm not losing sleep at night. When I go to bed, I know that my stocks aren't going to fluctuate that much overnight to a point where I need to be freaking out about it, which is something I was doing before when I was investing in penny stocks or doing other strategies. So a little bit of a personal preference there, but it's definitely easier to maintain these growths over a longer period of time if you know you're buying and holding. So for example, what I'm doing is investing in those dividend aristocrat companies, the ones that have been increasing their dividend payments for over 25 years. And I look at their earnings, their revenue. I take into account a bunch of different things about the stocks in order to identify them as one that I want to hold in my portfolio. And if you're wondering specifically how I am choosing these stocks to buy and hold, then I'll put a link to a video that I talk about exactly what I'm doing for my strategy. At times it can be really high level, but I try to break it down as best I possibly can. So if you do have any questions about that, you can leave a comment on any one of my videos, or you can reach out to me on one of my social media accounts linked in the description. The second thing that I'm going to talk about is market timing. Now, a lot of people think that they can time the market and they really understand when the market's going to turn for the worst or when it's going to turn for the better. And I'm here to tell you it's super hard to do that. So you may not always want to try and time the market. There is a saying, time in the market is better than timing the market. So it's interesting. It really lies within your own personal beliefs. What I've found that is super effective is just investing, over time, basically putting in more and more money as time goes on, and it's going to alleviate yourself and just get you into the market at a much safer clip because you're not just putting all your eggs in one basket. Say you decided now's a good time to go in and you just threw your money into the market, and tomorrow the recession hits and you just lose out on so much profits that you could have had if you just had invested over time, and then the market turned around and went back up. And on the other side, if you see that the market starts to crash during a recession, you might try and time when it's going to go back up, and that also could be very hard for you to do. So just keep in mind that market timing isn't always the wisest thing. So my third growth tip for everybody out there is diversification. And I know you hear this and see this everywhere, but I can't stress the different types of diversification enough. So if you're investing in a particular industry, let's say technology, for example, you find one really good company that you think is poised for growth and you just see a huge return in the future from them. So you decide, hey, let's just put all my money into that stock. You put it in, another company comes along, knocks them out, and basically you just lost a ton of money doing that. So what I would recommend is, taking that money when you first go in, say you are looking at the technology industry, yeah, sure, throw some money into that company. Maybe make your portfolio more weighted towards that company if you really like what you're seeing, but don't exclude other companies in the same industry as that. If you think the technology industry is going to do really well, spread it out a little bit, perhaps you could go into an ETF. There's tons of different ETFs out there. There are industry tracking ETFs. There are ETFs for the S&P 500. There's just ETFs for everything you can think of. So you might want to look at that. And if you don't know what an ETF is, it basically acts as a basket of stocks. So instead of getting one particular share, you're getting a huge breadth of companies out there. Typically, it's professionally managed too, so it's a little bit more hands-off. Now, another style of diversification would be within industries. So if you're investing, you're not going to want to put everything in one industry unless you're super certain that that's the only industry that's going to do well over the next, couple of years or what have you, however long your goals are for investing. But basically, you want to throw a little bit into technology, some into consumer products, some into minerals mining, some into natural resources. You want to have a nice breadth to your portfolio. You want to cover all grounds. That way, if an industry is doing particularly well, you have some feet in there. You can do well and get those gains. And if an industry is doing particularly bad, then you're going to have some growth in other industries to kind of mitigate what you did for the damage in those declining industries. Now, there's tons of different ways that you can diversify, so just make sure that you aren't just putting everything into one stock. You're essentially gambling if that happens if you're not doing the proper research behind it. Now, this kind of transitions really well into tip number 4 here, which is to invest in growth sectors. So definitely include that diversification that I talked about, but if you want to particularly invest in some sectors that show promising growth, you can look at sectors of the economy such as technology, healthcare, construction, small cap stocks, basically to get above average returns. And the only thing that I really have to mention here is that there's greater risk and volatility to this, but if you're comfortable with that, that's okay. Just make sure that you're setting up your portfolio to align with your goals so you don't have to be worried about it at all times. Now, this brings me to my 5th and final tip, and that's basically dollar cost averaging. I can't preach it enough. I talk about it all the time on my YouTube account. So if you watch my videos, you'll notice that in most of them, I kind of weave in and out dollar cost averaging strategy. It's one that I live by. Basically what you're doing is investing in stocks over a longer period of time. So let's say Microsoft, for example, you started to invest in Microsoft when it was around, 139 right now. Say you were investing at 139, the stock drops for some reason. Let's say it drops to $120. Basically, don't panic if you believe in Microsoft and you think that they're going to do well in the long run. In fact, that just represents a better time to buy. So buy more stocks, drive that cost down. So let's say for some reason Microsoft drops all the way to $100. If I've been buying all the way from $139 down to $100, the stock takes a turn and it starts going back up. My average might be somewhere around $115. Let's say it gets up to $130 again, then I'm already profiting from that. But if it continues to go up, then I'm only going to be able to recognize higher gains. So it's super important. You can get a lot of money this way, and dollar cost averaging is the preferred method of choice for a lot of different investors, and some of the most famous investors out there definitely practice this method. So I would highly advise doing this just to help that consistent growth. But anyways, guys, that is the 5 most important tips in my own opinion for that consistent growth on the stock market. There are a lot of different ways that you can achieve that consistent growth. So if you have any other tips or tricks and you want to share them, make sure you do so in the comment section. I'm always looking for new information on stocks. And then if you guys enjoyed the video, make sure that you leave it a like. If you have not done so already, subscribe to the channel. I'm putting out a ton of content pretty much daily around the stock market with my insights into it. So if you're interested in that, definitely hit that subscribe button. Thanks for checking out the video, guys. Have a great day.